Stocks. Last week we showed you that the market closed right on an inflection point, a very important trend line that goes back over the last 3 years. We got a great bounce off of that this week. Is it a dead cat bounce? Is it going to give it up and go back to the lows? I'm going to show you some green shoots. There's some things I'm seeing in the market that is encouraging, and next week's going to really be the tell of whether you can be back to buying this market or if you have to continue to be on the sidelines. So last week, we shared with you this longer-term chart of the S&P 500 from 2009 to 2025. We drew a line, what you would call the reversion to the mean line, okay? So this is long-term support. And what you need to know is that markets, when they trade away from this long-term support, they will have a tendency to eventually snap back towards the mean. This is like the balance of life. This is the balance of nature. This is when you realize that markets do have some natural rules to them, which is if things get too parabolic or they get too pulled away from their base, they will eventually come back and revert to it, okay? Balance. So we also showed to you that there's this uber bull line. Like this started in 2023, and if this current market decline is a buying opportunity and the stock market is going to go back to the old all-time highs or higher, then we would want to see this line hold and any decline. And last week we closed right on it. You can see we dipped below it and then we closed right on it. And this week we've bounced from there. So let me give you an update there. So we said this is the intermediate term support. It's been there for 2 years. Trading above it is great. Trading below it, not so much. So now what I did here is I shortened up this chart to being the last 3 years. What you saw before was the last, call it 15 years. And now this is the last 3 years. And this dotted line is that long-term support, okay, right there. So that's that. But basically what we've been saying is this is the bull-bear dividing line, that if you're above this line, the market trend is still bullish. So the rule book says buy the dips. However, sustained trade, we break below this and stay below it, then the rule book switch from buying the dips to selling the rips. So we haven't closed below it before yet. We've whipsawed it. We played around with it. I told you last week that the early tell line will be how we get to back around 5,600. I also mentioned last week that I was concerned on the relative strength because making this type of pattern and low was not a great impression. However, there are some green shoots happening here that have me encouraged. So here's an updated chart. I shrank it down to the last year. There's that long-term or that intermediate term bull-bear line, buy the rip or buy the dip or sell the rip. And now what's encouraging is the relative strength this week paused and pivoted back higher while the market bounced right into resistance. So how we close today, and the market isn't closed yet as I'm recording this, and how next week trades is really important because basically that short-term resistance line and that bull-bear line, everything that happens in between there is noise. And so we could bounce around there for another week or two, trade back down to 5,300, back up to 5,400, and burn some time. Everything that happens between there, what Trump says, what Brissett says, what anybody says is noise. What really matters is what happens above or below there. So if we can get above that green line, that red line, and sustain trade above that short-term resistance, that's very positive for the market and adds another anecdote. Adds flavor to the conversation of was this a buyable dip? Okay, and if we do trade above that that red resistance line I show you there, call it around 5,500, and you're probably going to hear me start to say, all right, hey, you know what? Some of the dangerous past, higher risk investors, people who are less time, not as time sensitive, maybe they can start to go back into buying the dips. So we'll see after next week. There's some green shoots, like I mentioned. And again, not trading advice, just sharing what I'm seeing out there. This first chart is Google. Google came out with earnings. They had a nice little response to earnings today so far. The green lines that I showed you here, the first one at the very bottom is the relative strength. And I just kind of showed that that's a very constructive building pattern and a stair-stepping higher, while the second green line above that, you can see that price made a low, then another low right here that's a little bit higher, and now has gone off to the races. So is this a buying signal? The real tell, and again, Amazon, same thing, very similar look. Next week will give us the answer, because that red dotted line, which looks like is right exactly where we're closing this week, that's the short-term resistance. Anything between the gray and red is just noise. Depending upon your time frame of investing and your risk level, you can do different things within that range. Below the green line is bear market territory. Above the red is, hey, this decline looks like a buying opportunity. Continue to monitor, or if you can handle the risk, maybe you start to dip your toe back in. There again, everybody's situation is different. Talk to your own financial guy before you start buying or selling. So the big question next week will be, can the MAG 7 get above resistance, stay above it? What does it all mean for you guys? Well, bottom line is this. If the S&P 500 is below 5,200, the bears have the ball. And the next target for me to watch is, how does the market react and respond to about 4,600? And if the market can get above S&P 500, 5,500, then it looks like the bulls have the ball, and bears should be very concerned or should be cautious. And the odds favor that we test the all-time highs, especially if you get above 5,600 is my analysis on this. So next week is really important to watch in the equity markets and the interest rate markets.